Did you know that right now the biggest names on Wall Street are simultaneously telling investors the same terrifying thing? Sorry, we can't give your money back right now. BlackRock, Blackstone, Blue Owl, Morgan Stanley, Cliffwater. These aren't small players. These are the gods of global finance, and they're all locking the doors at the same time. This isn't some isolated incident. This is a $3 trillion shadow lending market that grew 4 times its size in just 6 years. And right now the cracks are splitting open. JP Morgan's CEO already warned about cockroaches. Mohamed El-Erian is screaming 2008 red flags. And the numbers coming out this week are worse than anyone expected. Today I'm breaking down exactly what's happening, why it's happening, why this will directly impact your portfolio, even if you've never heard of these funds, and the 3 numbers you need to watch like a hawk from this moment forward. Let's get into it. Part 1. What is private credit? The 60-second crash course. Before we dive in, you need to understand one concept, or nothing that follows will make sense. You know public markets, stocks, bonds, ETFs, or exchange-traded funds? You can see the price, buy, and sell anytime. That's the transparent world. Private credit is the opposite. It's a shadow lending market where specialized funds, not banks, lend money directly to companies that traditional banks won't touch. Think of it as a legally sanctioned loan shark operation, except the loan sharks are wearing Armani suits and managing your pension fund's money. Here's how it works. A mid-sized company needs cash, but the bank says no. Too risky, too much regulation after 2008. So a private credit fund steps in and says, we'll lend you the money, but the interest rate will be 8 to 10%, and it floats. When market rates go up, your payments go up in real time. For years, this worked beautifully. The lenders collected fat returns. Investors piled in. The market exploded from roughly $800 billion in 2020 to over $3 trillion today. In just 6 years, it quadrupled. But here's the critical change that turned this into a ticking bomb. The investor base completely transformed. Originally, only massive institutional players, pension funds, insurance companies, sovereign wealth funds were involved. But then Wall Street lowered the barriers. They created semi-liquid structures where ordinary high-net-worth individuals and even 401k retirement accounts could invest, with the promise that you could take some of your money out every quarter. That quarterly redemption window sounded reassuring. It was actually the fuse that would ignite the entire bomb. And now it's been lit. Part 2. The domino chain, Blue Owl to Blackstone to BlackRock to everyone. Domino number 1, Blue Owl Capital, February 2026. The first crack appeared at Blue Owl Capital. Their fund, OBDC2, had been getting hit with mounting redemption requests throughout 2025. By February 2026, the dam broke. Blue Owl officially announced, "We cannot return your money in cash right now. We'll sell assets and pay you back over time." They fire-sold $1.4 billion in assets. Their technology-focused fund, OTIC, saw redemption requests hit 15% of total assets. Within 6 months, Blue Owl stock collapsed 40%. Their total market value evaporated by roughly $24 billion in about a year. They've now been hit with securities class action lawsuits alleging they misled investors about liquidity. Imagine you put your money into an exclusive investment club. You ask for it back. The manager says, "We don't have cash right now. We'll sell the furniture and the chandeliers and pay you later." That's essentially what happened. Domino number 2, Blackstone, March 2026. Next fell the biggest domino of all. Blackstone's BCRED, the largest private credit fund on the planet, $82 billion in assets. Investors requested redemptions of a record 7.9% of the fund's shares, roughly $3.8 billion, but the fund only guarantees 5% quarterly redemptions. So what did Blackstone do? Something that sent chills through Wall Street. The firm and over 25 of its employees personally invested roughly $400 million of their own money to plug the gap, while raising the redemption cap from 5% to 7.9% on an emergency basis. Stop and think about that for a second. The The world's largest alternative investment firm had its employees digging into their personal savings to prevent a fund from breaking. Imagine walking into the biggest, fanciest bank in your city to withdraw your savings, and the bank manager and tellers start pulling money out of their own wallets to pay you. Would you feel reassured? No. You'd think, if their vault is empty, how bad is this really? Domino number 3, BlackRock. March 6, 2026. Then the ultimate giant fell. BlackRock, managing over $14 trillion globally, roughly 7 times the entire GDP of many major economies. Limited withdrawals from its HPS corporate lending fund, known as HLend, a $26 billion flagship. Investors requested 9.3%, nearly double the 5% quarterly guarantee. BlackRock paid out exactly 5% and told everyone else to wait until next quarter. The shutter came halfway down. BlackRock's stock dropped 7% in a single day. Domino's number 4 and 5, Cliffwater and Morgan Stanley, March 10th through 11th, 2026. Just days ago, Cliffwater's $33 billion flagship fund received redemption requests of 14%. They honored only 7%. Morgan Stanley's North Haven Private Income Fund capped at 5%. The exits are getting more crowded by the week. Here's why this structure is so fatally dangerous. The moment investors see that redemption gate drop, the moment they realize they can't get all their money out, only one thought remains: I need to be first in line next quarter. It's the burning theater problem. If the building's on fire and the emergency exit is narrow, only the people who run first survive. The people who wait get crushed. That's bank-run psychology. One person panics and pulls money. Others see it and panic too. The fund has to sell assets to pay them. But these aren't stocks. They can't be sold instantly. They get dumped at fire sale prices. Those fire sales destroy the value of everything else left in the fund, which triggers more redemption requests, which forces more fire sales, a death spiral. Part 3, the real root cause. It's not just fear, it's AI eating the collateral. Now the headlines say, investors are panicking. But the real question is, why are they panicking? Why now? The surface answer is fear. But the deep structural answer is far more terrifying. The assets backing these loans are being systematically destroyed by artificial intelligence. Here's the connection most people miss. Private credit funds didn't just lend to random companies. They overwhelmingly lent to one specific type of business: SaaS companies. Software as a service. Between 2015 and 2025, over 1,900 software companies were acquired by private equity. Deal volume exceeded $440 billion. S&P data shows private credit funds lent approximately $750 billion to software companies alone. 1 out of every 4 private credit loans is tied to the software sector. Why did they love software so much? Because subscription revenue is predictable, margins are high, and customers rarely leave. It's too painful to switch systems, retrain employees, and migrate data. The stickiness of software subscriptions was the collateral that private credit lenders bet everything on. Then AI happened. Not AI stocks went up kind of happened, the real kind. Agentic AI systems, Claude, GPT, Copilot, and their successors started doing what those expensive enterprise software subscriptions used to do. Project management, document processing, HR systems, customer support, data analysis. Businesses started asking, why am I paying $50,000 a month for this SaaS tool when an AI agent can do it for a fraction of the cost? Subscriptions started getting canceled, revenue started falling, and suddenly the perfectly safe collateral backing, hundreds of billions in private credit loans started evaporating. UBS published a devastating analysis. Up to 35% of private credit portfolios face elevated risk of AI disruption. In a severe scenario, they estimate $1.6 to $1.8 trillion in total drawn exposures are at risk, with 30 to 40% tied to private equity, private credit, and BDCs. That's business development companies. Already, $46.9 billion in software loans are trading at distressed levels. Fitch reports the U.S. private credit default rate hit a record 9.2% in 2025, with small company defaults at a staggering 15.8%. And January 2026 saw default events double the 2025 monthly average. Part 4, the leverage trap, debt on top of debt. But the AI disruption alone doesn't explain why this is systemic. To understand that, you need to see how these funds were really making money. They weren't just lending investor capital and collecting interest. They were using a technique called back leverage, borrowing money from banks against their existing loan portfolios, then using that borrowed money to make more loans. It's like taking out a mortgage on your house, then using that cash to buy another property, then mortgaging that property to buy a third. Each layer amplifies returns in good times and amplifies disaster when things go wrong. This back leverage is what turned 8 to 9% yields into double-digit returns that attracted billions from investors. But when the collateral starts deteriorating, when software companies can't pay their interest because AI is eating their revenue, the banks that provided the back leverage start getting nervous. And that's exactly what's happening. JP Morgan just marked down the value of loan portfolios it holds from private credit funds after reviewing the impact of AI-driven market turmoil on software sector loans. When the biggest bank in America starts writing down the value of these loans, it's the financial equivalent of a seismic tremor. The total bank exposure is staggering. According to Morningstar and MarketWatch data, Wells Fargo has approximately $59.7 billion exposed to private credit. Bank of America has roughly $33.2 billion. Deutsche Bank just disclosed $30 billion. JP Morgan has committed $50 billion to direct lending. These aren't isolated, contained pools of risk. They're arteries connecting the shadow lending world directly to the heart of the global banking system. Jamie Dimon's cockroach theory fits perfectly here. When you see one cockroach in your kitchen, it doesn't mean just one got lost. It means there are hundreds, maybe thousands, behind the walls you can't see. Blue Owl, Blackstone, BlackRock, Cliffwater, Morgan Stanley. These are the cockroaches that crawled into the light. What's still hiding behind the wall? Part 5, the triple collision, redemptions plus maturities plus defaults. What makes this moment uniquely dangerous is that 3 forces are hitting simultaneously. A triple collision that none of these funds were designed to survive. Force number 1, the redemption wave. Investors across every major fund are racing for the exits. BlackRock, 9.3%, Blackstone, 7.9%, Cliffwater, 14%, Morgan Stanley, 10.9%. These numbers are climbing every quarter. If they continue rising, it's no longer a rainstorm, it's a flood. Force number 2, the maturity wall. According to Fitch, 23 out of 32 rated BDCs have unsecured debt maturing in 2026 totaling $12.7 billion, a 73% increase over 2025. These funds have to pay back the banks they borrowed from this year. They need to refinance. But in a market where everyone is spooked and banks are tightening collateral requirements, refinancing is becoming much harder and much more expensive. Force number 3, the default cascade. Software companies' revenue is falling as AI disrupts their business models. They can't pay interest on their loans. Defaults are accelerating. Fitch's default rate, 5.8% and climbing. UBS worst case, 15%. The 2008 financial crisis peak default rate was 8 to 10%. We could be heading past that. When these 3 forces collide, investors demanding money back, banks demanding repayment, and borrowers unable to pay, the fund has no choice but to dump assets at whatever price the market will bear. And here is the truly terrifying part. Nobody knows what these assets are really worth. Unlike stocks, where Samsung or Apple has a price that updates every second, private credit loans are valued by the fund manager themselves. They grade their own exam. They've been writing a plus on their books for years. But when they're forced to actually sell, that's when the market discovers the real grade. And if the real grade turns out to be F, the panic won't be limited to private credit. It'll tear through every connected market. Part 6, the global transmission, how this hits your portfolio. But I don't own any of these funds. Why should I care? This is the most dangerous misconception you can have right now. Here's how the contagion reaches you even if you've never touched private credit. Transmission channel number 1, the risk-off cascade. When institutional investors, pension funds, insurance companies, sovereign wealth funds, see private credit cracking, they don't just sell private credit. They sell everything risky. Stocks across global markets get dumped as institutions de-risk their entire portfolios. Your stock holdings, whether they're in New York, London, Tokyo, or anywhere else, get caught in the crossfire of a global risk-off wave. Transmission channel number 2, credit tightening. When banks see their private credit exposures deteriorating, they don't just tighten lending to private credit funds. They tighten lending everywhere. Corporate borrowing costs spike. Companies across every sector find it harder and more expensive to get financing. This slows economic activity, hurts earnings, and drags down stock prices globally. Transmission channel number 3, the dollar squeeze. This crisis is centered in US dollar-denominated assets. When it intensifies, global demand for dollars surges as investors flee to safety, strengthening the dollar. A stronger dollar hurts every company that earns revenue in non-dollar currencies and pressures emerging market economies that have dollar-denominated debt. If you hold international stocks or emerging market assets, you're directly exposed. Transmission channel number 4, pension and insurance exposure. Many of the institutional investors in these private credit funds are pension funds and insurance companies. If their private credit holdings take losses, it affects their ability to pay pensions and insurance claims, which can ripple into government bailout discussions and broader fiscal stress. According to the IMF, US and European banks have $4.5 trillion in total exposure to non-bank financial institutions, including private credit funds. The evidence is already visible. Even in just the past few weeks, as private credit headlines dominated, major global financial stocks have taken hits. This isn't theory, it's happening. Part 7, the 3 numbers to watch and 3 risks to fear. Let me give you the exact roadmap. There are 3 numbers you need to watch obsessively and 3 risks that could turn this from a storm into a catastrophe. 3 numbers to watch. Number 1, next quarter's redemption rates. BlackRock, 9.3%, Blackstone, 7.9%, Cliffwater, 14%, Morgan Stanley, 10.9%. If these numbers rise next quarter, if the exit line gets longer, not shorter, it's the clearest signal that this is escalating from a rainstorm into a systemic flood. Watch these numbers like your financial life depends on it, because it might. Number 2, fire sale pricing on asset disposals. Blue Owl sold assets near book value. That was the best case. But as more funds are forced to sell to meet redemptions, watch whether assets sell at steep discounts to their stated book value. If funds start dumping at 60 to 70 cents on the dollar, it means the grades they gave themselves were inflated, and the entire market's trust in private credit valuations collapses overnight. Number 3, bank credit line tightening. JP Morgan already marked down private credit loan values and is tightening collateral requirements. If Wells Fargo, Bank of America, and other major banks follow suit simultaneously, if they all start closing the valve at the same time, the blood supply to the entire private credit market gets cut off. That's the financial equivalent of a cardiac arrest. 3 risks to fear. Risk number 1, the default domino. AI is structurally destroying software company revenues, causing loan defaults to accelerate. Fitch default rate already at 5.8%, with UBS warning of 15% in the worst case. With $12.7 billion in BDC debt maturing in 2026 alone, 73% more than last year, an acceleration in defaults could become unstoppable. Risk number 2, the valuation illusion shattering. Private credit assets don't have real-time market prices. Fund managers self-report values. As forced sales reveal actual market prices, the gap between what funds claim their assets are worth and what they're actually worth could trigger a crisis of confidence that makes the panic exponentially worse. Investors who've never experienced this kind of a liquid asset write-down are the most vulnerable. Risk number 3, bank contagion. With Wells Fargo at $59.7 billion, Bank of America at $33.2 billion, Deutsche Bank at $30 billion, and JP Morgan at $50 billion in private credit commitments? If this market cracks hard enough, bank balance sheets take direct hits. That's not shadow finance anymore. That's the core banking system. And the 2008 subprime market that triggered the global financial crisis was $1.3 trillion. Today's private credit market is over $3 trillion, more than double that size. And unlike 2008, where at least the toxic assets were wrapped in identifiable securities, today's risk is hidden in funds that grade their own exams in total darkness. Conclusion. Here's the bottom line. The financial world has a peculiar rhythm. On the surface, everything looks solid and prestigious. BlackRock, Blackstone, the greatest names in finance. But underneath, greed and unchecked growth always collide with reality eventually. For the past decade, private credit sold a seductive promise. Safe returns higher than anything else, guaranteed by sticky software subscriptions. Then AI arrived and started shredding those subscriptions. High interest rates sent the cost of debt soaring. And now, simultaneously, investors want their money back, banks want their loans repaid, and borrowers can't pay. The triple collision. Does this mean 2008 happens again tomorrow? No, not yet. Goldman Sachs notes the overall default rate is still at 2.3%, below historical averages. But dismissing this as a few funds having redemption issues is like calling the first tremor before an earthquake just some shaking. The three signals, redemption rates, fire sale prices, and bank credit tightening, will determine whether this bomb detonates or gets diffused. Watch them closely. If this breakdown helped you see something you couldn't see before, hit that like button. It's free and it helps Dr. Owl Invest reach more people who need to hear this. Drop your questions in the comments, any stocks, any economic topic you want dissected. I'll pull all-nighters digging through reports, fact-checking everything, and bringing it to you in the next video. Subscribe and turn on notifications so you never miss a breakdown. This is Dr. Owl Invests. Let's build real wealth together.